Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, we are getting into the Energy Desk on a Thursday, mixing things up. So we're here on January 30th, and we still have some good stuff to talk about. But what's your take on the week so far?
Oh, interesting. A little less confusing than last week, and yet not exciting for anybody that is long hydrocarbons, which I think we'll cover today. Maybe some of the strangeness and why it would be such a negative week for hydrocarbons, considering some of the headlines.
Yeah, fewer executive orders, at least, it seems like this week. So one of the cooler topics or more interesting trends or commentary pieces that came out was the DeepSeek R1 model that was open sourced by Chinese research lab DeepSeek. And it kind of caused a little bit of a stir. What was your initial impression on Monday to some of the reactions that we got?
Yeah, I'll start with crude. In some ways, I kind of understand why crude went lower on that news, not because crude should really have any material translated impact to whatever the sentiment is on AI, but simply because crude tends to track equity markets far more than any other hydrocarbon or energy commodity for that matter. And, I guess an important thing to flag is the headlines talk about how it was such a negative day for equities. Let's be clear. It was a bad day for the NASDAQ, which is heavily weighted to NVIDIA, which took the brunt of the losses, and it didn't impact the Dow at all. And we saw a lot of it unwound. So, I think maybe we'll go through some of the nuances to land on a conclusion as it relates to DeepSeek. Our clients, many of them asked about it this week. And as a broad and maybe unfair generalization, so disclaimer, I'll take the pushback if this is unfair. It really doesn't matter right now in any way, the DeepSeek news. So I'm putting my own neck on the line.
Yeah, I think it's an interesting, especially as you said, the initial knee-jerk reaction, I think, was fairly misguided because when you look at, I guess, the underlying technology that a open source reasoning model that is compared to something like OpenAI's O1 Mini or their more advanced O1, those are very energy intensive and they require a lot of compute. The only hardware that can run that are the chips manufactured by Apple, NVIDIA, and AMD. So currently only 3 providers of those chips that can run a model that is as advanced as DeepSeek R1. So the initial reaction doesn't make much sense there for the equity side, but I think it was really interesting to see the kind of overlook that the energy demand side got, because when we're looking at these more advanced models, it's a little bit like a order of magnitude or a step change in energy intensity. So we jump from a Google search to a GPT-3 and then GPT-3 to GPT-4, 4.0. And we keep kind of going up in the energy intensity in a lot of ways. And when you open source a model, one of the takes that I think was not really recognized, at least early on, is when you're open sourcing, you're making it more accessible to consumers and you can run it on your own hardware. So we ultimately have more people using a more energy intensive model, and that is certainly bullish for energy consumption. Yet we had a different reaction on the natural gas side. I
will admittedly say that I am about as far from an expert on anything AI as possible by choice, and maybe I'll just be an old dinosaur until I become extinct. But I think there's another piece that in your summary there that was left out. So more people with access, we use more of it, and then piecing that together with something you said earlier, which means more of the same chips. So maybe this was just an incredible buying opportunity for somebody that missed out on an incredibly prolific NVIDIA rally over several years now.
Yeah. Yeah, I think so. I think it's an interesting, as you mentioned, the immediate consequences of the model, maybe not as relevant as people wanted them to be, but when you kind of abstract the news and you're looking more long term, I think this does indicate the trend that we're going to see more and more of, where this export restrictions on advanced chips like NVIDIA's best chips to China really forced this research group to be resourceful and kind of implement novel training methods where they saved a lot of the training costs. And reportedly, they were able to cut that down to 6 million. There's some debate around whether that's true or not. But I think regardless, what they did accomplish was cutting down the waste of training just extremely, extremely large models that are, at times approaching a trillion parameters. So this one is about 670 billion parameters, or kind of the iterative process and some of the techniques that they had to use to predict how the model would perform. I think that will be adopted by the broader industry. And I think this will also translate into more open source technology that is at least comparable to what we get from the firms like OpenAI. So I think that when I look long term, it definitely points to the demand not really being appreciated, even though it's an interesting place because you have people extremely bullish, more bullish than they've ever been for energy demand or electricity demand from AI. But I think in a lot of ways, it's hard to understand compounding. And when you have nonlinear growth and slow adoption in certain communities, that creates an interesting picture for sure.
Well, and then back to, I guess, the question you asked that I redirected from and didn't answer. Yes, natural gas had a tremendously rough day on Monday when this news came out. And unequivocally, the news had nothing to do with the move in natural gas. Why did natural gas go down on Monday? Far less correlated with any economic news unless we're just in an outright recession. Natural gas went down very simplistically because Mother Nature decided it was time for it to go down.
Right.
Meaning there was a 20 HDD loss reported by most weather vendors on Monday. That would correspond to about a 40 BCF loss in demand over a 2-week period. And that's why we went down, and arguably why we've still drifted lower throughout the week as equity markets have largely recovered. Well, I don't know. At this point, I'd have to go back and check the stats, but I think we're pretty much back to where we were before the news from DeepSeek on Monday. So we'll get back to natural gas in a bit. I think it's maybe sticking on the topic of all things AI and the demand side. And before we go there, like you just mentioned, the path forward, and it seems to be paved with an even smoother surface with this latest news to increase demand from this sector of the technology world. It's going to go higher, and none of us really knows exactly how much higher and how intermittent that will be with an increasingly intermittent power grid with renewables. So before we move on to core commodity related stuff, maybe let's go to the latest Stargate news. That was one of the executive orders last week. Essentially, we're going to build out the mothership of all the world's AI needs here in the general center of the U.S.
Yeah, so talked about that announcement last week that President Trump announced on behalf of a group of the tech giants and SoftBank and others. I think one of the things that we've really talked about for over a year now is the speed with which various types of generation resources can meet demand and how reliable those generation resources are. So the big interest headline-wise for 2024 was really this resurgence in nuclear. But as we kind of discussed, very optimistic about nuclear, just have to recognize the limitations for the regulatory side and kind of the history of the US's construction timelines for new nuclear capacity. So as we kind of talked about on that side, when you need reliable generation, probably going to see a lot of these players turning to gas-fired generation. This week, we got that kind of confirmation. It's still not something that they're just shouting from the rooftops, but the information had a few sources, the information being a media outlet, had a few unnamed sources tell them that the Stargate developers are building their own natural gas-fired plant, supposedly 300 megawatt unit, to power that facility. And so I think the current state of the Stargate project, the data center that is getting constructed right now or being constructed right now, is supposed to be about 200 megawatts. So that unit would probably meet that first data center. Their plans are to increase the data center campus to between 1 and 2 gigawatts. So still have quite a bit to go. But I think that was also followed by an interesting comment in the information article that we had an announcement with Engine Number One, an investment firm, and Chevron for up to 4 gigawatts of power over the next 2 years that they want to site next to data centers. And that'll come from 7 GE Vernova gas turbines. So I think we're kind of getting this early indication of what will probably be a steady stream of the same pattern for other data center developers as well.
Can't help but find the irony here. You're going to have to go back and fact check me on this one. But I'm pretty sure Engine Number One was the entity that took an activist investor role in going after Exxon when we were all things fossil fuel are bad. Yeah. And here we go right back the other way in less than 2 years. So maybe just plays on the short-term memory, like, oh, no, these are terrible. Oh, wait, no, let's partner with one and let's make something.
Yeah. So we'll be interesting to watch that one. Yeah.
Well, and then I think the other thing that's kind of interesting here is yet to be determined where these 4 gigawatts of generation would be sited. And anybody that is in the weeds in the North American natural gas market for sure would understand the very consistent pressure on Permian MMBTUs. So what if these 4 gigawatts were sited in an area that supposedly is constantly on a struggle to figure out where to move these MMBTUs to, that nobody really wants, that just come along the way with the oil production that people are trying to bring online? Well, 4 gigawatts would be about 800,000 MMBTUs a day, which is about half the size of most of these pipelines that get built. So could you, in theory, build a, let's call it a pipeline, if you will, and it would be a short one, from the field straight to a power plant and skip the need to get it out of there at all? I think it will be interesting to continue to follow this story, and hopefully there's somebody else that calls out Engine Number One on this. I can't help, but that's just too comical.
Yeah, there's definitely been some commentary on it. I think your comment is on to something that we'll definitely see more of as well. Bringing the energy molecule closer to the generation and potentially bringing the compute or the inference closer to the generation and the energy molecule. So yeah, definitely we'll have more updates on the AI front. As always, things are moving quickly. But I think maybe that gives us an opportunity to talk about this week's natural gas inventory and maybe other commentary that you have.
So, we started the week with a exceptionally bearish change in weather forecasts. That theme has continued throughout the week. And then we land today, Thursday, January 30th, on a weekly EIA inventory report, which was announced at a withdrawal of 321 BCF. How does that compare historically? Clearly, that's large. How large? Well, the largest withdrawal on record is 359 BCF. We've commented in prior podcasts that we don't know that that's actually ever going to be a benchmark reached again, because the spot market or the physical market has learned how to price up in a hurry to avoid such withdrawals. However, at 321 BCF, it is both A, larger than what was expected, closer to 310 BCF, and B, very near the one cold week last winter when we took out 326 BCF. So what's the takeaway? Well, if it's pretty near last year and the weather was relatively similar, then the market's certainly not oversupplied. Is it definitively undersupplied on that number? No. And what does that mean about the path forward for natural gas as we move through the final 2 months of winter and into the early part of the 25 injection season? It means very little. because what will matter the most is what weather forecasts look like. Interestingly, there is still a significant amount of cold air stacked up in Western Canada, according to the latest weather model output, that could make its way into the lower 48. Now, we're unquestionably pricing as if winter is already over. The new prompt month contract March down a dime today, just about a nickel over the $3 mark, trading under the April contract, which is typically a spread when March is under April. The market believes that winter is over. And fascinatingly, even the current bearish forecast, and when you take that into context of what seasonal forecasts for February and March are, the remainder of this winter, and not that seasonal forecasts are, a whole lot better than a coin flip, but if you take them at face value, we'd have about 160 HDDs more for February and March than we did last year. 160 HDD increase would be at least a 300 BCF, maybe as much as a 325 BCF increase in demand year over year, which would have us at an end of March inventory level at somewhere near 1.7 TCF, maybe slightly higher. That would be about 500 BCF lower than last year. So how confident could the market really be that we're going to inject 500 BCF more than we did last summer, which would be well over 2 TCF based on all of the S&D factors, which include, importantly, a substantial increase in year-over-year LNG feed gas demand and an uncertain path on production. Mm-hmm. So I'll go back to one little nugget on today's EIA inventory report, and I think it is an important one to contemplate. Salt storage fell by 68 BCF. We talked about this year's overall versus a cold week last year, which ironically both were on the MLK weekend, or fell over the MLK weekend. One other really interesting data point in this week's EIA inventory report is found in the salt storage withdrawal at minus 68 BCF. That compares to the similar cold week last year at minus 60 BCF. So why would I really care if 8 BCF more was withdrawn in salts in this year's cold event versus last year's? Well, A, the overall number was lower, but B, the salt withdrawal was larger. And then how does that fit with the thesis that there's too much gas in the south central U.S. due to all of the prolific Permian growth, and that the Haynesville will be producing more as we climb over 350? So not going to propose that there is an answer to that question, but I think it's a really important one to consider as each subsequent weekly inventory report comes out. And what is the salt storage change? At present, salt storage stands at 229 BCF. That's about 25 BCF lower than the low from all of last year, which almost every year is in Q1. And so the relevance there, if we're already lower and we've got, 9 weeks of winter left, how much lower can we fall? With the contextual data point to really be fixated on is it possible that we land at the end of this winter between 150 and 200 BCF in salts? Historically speaking, when salts fall to anywhere in that 150 to 200 range, there is a surprisingly strong physical market. The storage bid is stronger than people anticipate. And then what does that mean? It has the market almost inexplicably for many pricing higher in the spring when the prevailing narrative is, oh, no problem, we have too much gas. So, the salt storage number going forward is going to be critical. And then I think that's, unless you got some color you want to add or some questions on it, maybe it's a good spot for us to pivot from the U.S. over to Europe and talk about inventory there.
Yeah, I think the EU inventory has been really interesting, just to kind of put it into context of TTF this week and last week. We notched another jump today over 1574-ish MMBTU for March. And I think really the interesting one, after I touch on the inventory stats, is to get your thoughts on the summer winter kind of pricing that we have this week and how that's changed over the month. But just kind of a quick snapshot of inventories. We have EU aggregate storage at about 54.7% full, so 55%. I think that 55% number is an interesting one to take a look at because that is one of the, I guess, recommended targets that the EU regulators put out as, hey, we don't want to let our storage get this low by February 1st. So really their target is 50%, but they said ideally we won't drop below 55%. So that's interesting. We're about 2.14 TCF. And, as we were talking about this morning, just kind of discussing some of the things going on in Europe, the weekly withdrawals have eased from where they were in kind of the middle half or the middle of January when we had, as we said, a little bit warmer weather, but Germany's wind fleet just totally collapsed. So you had about a week of very little wind generation, and then you had kind of consecutive days of around 30 BCF withdrawals from aggregate EU storage. So
daily withdrawals, yeah.
Yeah, daily withdrawals. So year over year deficit now is about 620 BCF. And yeah, I think maybe getting your thoughts on the summer pricing and how that is kind of playing into the whole EU storage mandates.
Yeah, you've got a very different dynamic in the TTF curve versus the hub. You've got the TTF curve that's hanging around that 1575 mark out through really September. So it's a pretty flat curve, certainly been on an upward trend. And it's the difference between a market, European, that is unsure if it can manage to prevent a dip to, how do you want to define it, uncomfortable or unacceptable inventory levels before the summer season begins. Now, you've got the hub that is quite the opposite, where instead of being backwardated in a flat curve, through the summer months, we're dipping back into steeper and steeper contango yet again, and pricing as if winter is over. So one market says winter is still on, one market says winter is over, and both of them have cold air potential that is in weather model output right now. So, wrote about it earlier this week in one of our daily updates. In some ways, we would define both as being in a state of paralysis. When uncertainty or paralysis arrives, what do? Well, you do what you did last. And for the North American natural gas market is, I guess I go lower. That's where we've been most comfortable the past decade. And for the European gas market is everything that happened pre-22 doesn't matter. So I guess that means we probably go higher here. I think there's a great deal of uncertainty of what the path forward is here, and just kind of fixate on two numbers. We already covered the salt storage one. I'm going to say it again at 229 BCF. That's pretty uncomfortable with 9 weeks left to go for salts in the US. And for Europe, already having seen total European inventory dip to where last winter ended, knowing that there's cold in the forecast and plenty of weeks where withdrawals can be substantial going forward. I think that the 2 TCF level in Europe, as we fall through that, and in the event that we were to race down towards 1.5 TCF, it becomes a situation where A, Europe can see prices move higher, B, a lagging Asian market, which is now even further behind Europe, front of the JKM curve, 14.25, let's say, so about $1.50 discount. And so if those two start fighting for the floating MMBTU, does that have a knock-on effect for the hub? Our answer would be yes, but only if Mother Nature decides that we're going to have some semblance of normal weather for the balance of the year. Undefeated heavyweight champ, if it's widespread warmth across the lower 48 in February, we'll find a way to go lower. Where the stopping point is will be a function of where the physical market for day-ahead gas trades.
Yeah, Europe has been pretty interesting as well because we have TTF specs for long interest at multi-year highs. And really that's ramped up in the last few weeks. I think the obvious answer is to look at the combination of the loss of Russian pipeline gas, and then you have warmer than normal weather, but you have faster than normal withdrawals. So that'll be interesting. I think what we have also talked about that plays into the near term kind of EU-US conversation is the Feb 23 chancellorship election for Germany. You have opposition candidates who are leading in the polls that are definitively more favorable to or more pro gas-fired generation, increasing gas-fired capacity, versus the traffic light coalition, who is kind of notorious for their anti-nuclear, anti-gas, anti-thermal, every kind of thermal generation for Germany. And so you have Feb 23 election that could lead to a little bit more favorable policy for gas-fired generation. And then I think the Trump tariff conversation and trade negotiations with the EU will probably play into that as well, with the bargaining chip of U.S. energy exports. And, we've talked about the limiting factors for export capacity, but it does seem like that will be a incremental support for at least U.S. prices. But do you have any thoughts on that?
I think that the one data point you shared, which could be one of the most interesting, is what if the European withdrawal pace slows materially and it gets warmer? I think when the spec community gets really long, you get this herd mentality. One runs for the door, followed by the next 50. And then all of a sudden it's this mass exodus, which presses the market lower than it needs to go fundamentally. It becomes a oversupply of derivatives, not an oversupply of MMBTUs, too much for the market to handle at once. When you look at the NYMEX market and you look at specs in North American natural gas, we're kind of in no man's land. We're certainly a lot longer than we were. I think this is kind of logical. Back in the fall, the market is, although it's backed off, it's certainly much stronger than it had gotten. And I imagine in this week's CFTC data, you will see a meaningful reduction in net spec length. And I guess for clarity, the natural gas market in terms of the specs are always net short. That's how low are the net shorts. Not always, but I don't know, 99 observations out of 100. So, in some ways, like, what if there is this big exodus from TTF? Does it create an opportunity for someone to express the view that the spread between the hub and TTF has gotten too wide? Buy the hub, sell TTF. Risky proposition. How many people are willing to put such a trade on? Probably very few. However, could the hub go up even without the benefit of what would be a glaringly obvious reason to rally, that being weather getting colder? It's a possibility. It can't be ruled out. I think we've seen a few times over the past several years where no one could really explain why the hub was going up. And if you looked on the other side of the pond, it was TTF going down. So a spread trade.
Yeah, I think we can leave the gas side behind and take a quick look at some of the crude data. I think you had some interesting commentary on how the inventory numbers have maybe gotten less supportive over recent weeks.
Just the past couple of weeks, it's kind of a strange situation. We'll start with crude. So the year-over-year crude inventory deficit held incredibly steady for several weeks in a row. Between the middle of November and the second report in January, the average for a 9-week period was minus 19 million barrels, and the range of outcomes is pretty tight at minus 17.2 up to minus 22.6. So the surplus was between, let's just call it 17 and 22, and it was pretty steady in there. Most of the data points are, in that 17 and a half to 19 range. And then all of a sudden, these last 2 weeks, you see that deficit plummet, or that year-over-year shortfall. It's now down to 7 million, or just under 7 million. And the streak of weekly crude withdrawals ended at 9. We didn't quite meet the record of 10 weeks in a row from back in 2017, I believe it was. And yet overall crude inventory is still low. I mean, domestic inventory is low. And if anything, it's just a trend of it doesn't look like we are as short. The same is true of floating stocks, which have seen some upward revisions to recent weeks' historical data. And then you've also got the latest data point that jumped up 10%. Crude inventory in Europe, while it didn't change, when you look at it on a year-over-year basis, it flips from a definitively consistent year-over-year deficit streak of, I believe it was 7 to 8 weeks, to all of a sudden decidedly positive. And it's just because the same week last year posted a big withdrawal. So I guess what's the take on the big picture for crude inventory? It's still low while the trend doesn't look favorable. And that can go right back the other way in a hurry. We'll use the US as an example. If we're going to fixate on year-over-year changes, if you take the last reporting period in January of last year through the final report in the month of February, what actually ends up being a 6-week period. It's the Jan 26, 2024 reporting period through the March 1, a cumulative crude stock increase of 27.9 million barrels was reported. So, unless we keep up what we just did at a 3.5 per week and then some, over a 6-week period, essentially I got to do 5 million barrels a week to, beat that pace and have the deficit that exists shrink some more. And then conversely, you could just even see some back and forth. There's a withdrawal here, a build there, and relatively unchanged. Then we'll wake up at the end of February and all of a sudden we'll be back to a substantial year-over-year crude deficit.
Yeah.
Last year still looks supportive to us, I guess I would say.
Yeah. Yeah. Last year's refinery maintenance season was fairly extended as well. And this year, everything I've been reading is that it's shaping up to be kind of the opposite of that. Do you have any takes to kind of put that into context? I think EU as well, refinery maintenance season kind of going on, and maybe how that plays into ARA.
Yeah. I think there's a multi-decadal history to rely on there. When one year has a longer and deeper outage season, that typically is followed by the next year, which doesn't, and which just kind of makes sense. If I have to do the major overhaul, then I don't have to do it every year. So that could certainly matter. More crude goes in, more product comes out, which we can transition to products here in a minute. I think for me, honestly, with refineries input, output, I don't know, whatever side we're going to talk about. I guess we're talking about crude inventory. So we'll talk about the inputs. Refineries ran harder in 2024 than they have in, I believe, 5 years. Mm-hmm. So it was a tailwind for crude and, in theory, a headwind for products. Most of last year, diesel fared, I guess, weak on a year-over-year basis, still strong historically speaking, but it just wasn't the excitement that it was in 22 and faded from 23 levels. And we had a period in Q2 with that refinery outage season you're talking about. And as we bump up against the early days of driving season, the gasoline crack domestically exploded, incredibly strong levels. I think we approached plus $35 a barrel. Mm-hmm. And, so what's the take? Well, I think big picture, unlikely that refineries are able to beat last year's pace in 2025. Could the outage season be fare better, meaning we take in more crude? Absolutely. And so could be a tailwind now, but could be a headwind beyond the, spring refinery outage season.
Yeah.
And I think that's let's flip to diesel.
Yeah.
I think that's the one to me that stands out is if we're going to have another meaningful recovery in the crude complex, it's probably going to have to be diesel led. It seems the best position to be the belle of the ball, if you will. So at 124 million barrels of diesel inventory, we are at the third lowest level since 2015. I use 2015 as a reference point. That's when we, first approved the export of crude again after a multi-decadal ban, and product exports also began to step up significantly. So the only other data points that are below that 124 million barrel mark are the fourth report in January from 2022 and 2023. So it's in some ways understandable that we're not below that level, so the crack spread shouldn't be as strong. I guess that's a straight line correlation, but it's still very low. And we just got a 5 million barrel draw reported yesterday. I believe it was 5. Yep, right at 5 million. So, any string of withdrawals in, I would say, even just the next couple of weeks puts diesel in the driver's seat of determining where the crude complex goes. And then if you put that back to the beginning of the storyline with, President Trump and a string of executive orders that are bullish fossil fuels, I think there's some rays of hope for the crude complex. Front month TI contract is certainly well off of its run over 80, back down to just under $73 a barrel. And the front month diesel crack, or I'll use March, a little under 30, or I guess maybe fairer to say a little over $28 a barrel. The diesel crack's in firmer territory than TI is. And so the relationship between those two in some ways is as important, if not more important, than where just the price of TI is trading, if you want to look for signals the market is sending.
Yeah. And on the spec community, one of the things that we pointed out earlier this week is just the kind of, mismatch between where crude length / crude shorts have come off in the last 4 weeks, where as we have diesel spec community at still pretty elevated levels, 82nd percentile, I believe, is the number. So still fairly elevated despite a fairly supportive fundamental picture.
Which that actually is not good for TI, because there is another thing, and we talked about the theoretical spread trade where you're long the hub, short TTF. You believe neither market is going to have any inventory issues. I mean, gutsy move to put a position like that on. Would not recommend it to anyone. But then when you look at the spread between TI and diesel and the way that the market's positioned, there could be a far safer and a rational view taken by a spec that says, well, I'm short TI and long diesel here. Who is there? Who's going to step in a big enough way with a big enough stack of chips to take the other side and run me out of this position? If the TI spec position has already gotten quite long, which it has in the past 6 weeks or so, and diesel length is, all but non-existent, then, in some ways kind of makes sense, certainly if it has to be a diesel-led move. And so where does that leave the TI producer or those exposed to the North American benchmark, wherever you are in the world? A little bit of a precarious position. The market's certainly not on as solid a footing. It's moved down materially. And, we've saw several moves down into the upper 60s, $67, $68 a barrel. That could happen in a hurry, not because anything's materially changed fundamentally for oil, but simply because there is a financial market that says it's time to get short crude and it's time to get long diesel.
Yeah. And I think the commentary with OPEC and kind of President Trump asking or requesting barrels to come back online and bring prices back down, I think that'll be a kind of a focus point for the next few weeks for sure, leading up to OPEC's next monthly meeting. Do you have any thoughts on maybe what people should be keeping in mind?
I don't know. Get out your pen, get out your paper. There's a lot of things to keep an eye on. Yeah. One might come tomorrow. I mean, you've got just in the next couple of weeks, theoretically, you got news on tariffs, U.S. versus Canada and Mexico as probably the most front and center. You've got the JMMC meeting that you mentioned, the OPEC JMMC meeting, February 3rd. You'll get Saudi OSPs at some point next week, most likely towards the end of the week. I mean, there's, I think the announcements will be fast and furious. It'll be, we'll see your executive orders, President Trump, and we'll raise you a whole lot of data points for you to chew on your decision to ask nicely with MBS, beg, plead, pick a fight. I think it's going to be a really interesting couple of weeks here.
Yeah.
I think that all bets are off, and it's where spec positioning becomes really important. The spec community got long with the belief that whatever Trump's actions were going to be in the first few days were going to be net bullish. And, at this point, I think it's clear to say that the market changed its mind and said, no, these were not bullish enough for me. And so we've backed away. I don't really have a strong opinion on, what Trump's next move will be with Saudi Arabia. But I do think it is putting the relationship in a precarious position. And could we be moving, faster and faster towards U.S. OPEC or U.S. Saudi price war? One way to make prices lower is bring on a bunch of supply.
Yeah.
Who wins, who loses in that one? I would say, us on this call, we get to buy cheaper gasoline, cheaper diesel, whatever it is you put in your vehicle. But both nations' economies being reliant, far greater extent Saudi Arabia than ours, on the price of energy, not great in that respect.
Right. Yeah. And I think the marginal cost of extraction is an interesting just data point to keep in mind for US versus OPEC. And, it seems to me like OPEC would come out of that on the winning side, even though it would be, I guess winning is not the right word, but can outlast with lower marginal cost of extraction.
Man, that's such an interesting topic. Who can really make heads or tails of that? In theory, Saudi Arabia has got a far lower extraction cost than we do. Mm-hmm. Yet you don't have enough fingers and toes to count the times that there's been a report that says, oh, well, the Saudis can't. It won't work less than $85 a barrel. And then you'll have somebody come back and say, well, that doesn't have anything to do with their extraction costs. That's the price they need to run their country.
Their debt.
So, are you saying that there's going to be a civil war and that, the monarchy in Saudi Arabia is going to get overthrown? I don't know, long putt. I'm going to shift gears a little bit. Another interesting thing to me, and tying to where we started, but sticking on all things AI and foreign relations, there's this interesting dynamic with the trifecta of Russia, India, and the U.S. So if you go back to the middle of last summer, Reliance Industries asked for permission from Big Brother U.S. government, Biden administration at the time. Hey, are you guys okay if we import some more Venezuelan barrels? We know that, theoretically your sanctions are back on again. I mean, they're still producing the same. So they got these extra barrels. You mind if we take some? Because your sanctions seem to be, bullshit. So, we said, yeah, sure, go ahead. Further adding proof to the point that our sanctions weren't really sanctions. And then, fast forward to late 24, Reliance comes in and signs a 10-year, 500,000 barrel a day supply deal with Russia.
Mm-hmm.
And then, so, how does this all piece together to AI? So, we've had this longstanding technological relationship with India. And does the foreign relation dynamic, that gets created in this triangle of Russia, India, US, have an impact on the progress on AI? That's the one thing I don't really, and maybe I don't read enough. Maybe people are talking about it. I think you probably read more than I do. There's an interesting roadblock there. Not that we, the AI train, can't still leave the station and move forward at a meaningful pace without any Indian participation.
Yeah.
But I think it's an interesting one to follow in the weeks and months ahead.
Yeah, I think we'll definitely see a lot more out of India within the AI kind of development community. There has been a lot of chatter about the absence of India kind of contributing to the large advancements or the material advancements. So it will be interesting to watch.
I think we left India off a list of, Indo-Pacific partners that would, it would typically be on as it relates to, I guess, our latest and greatest and best chips. So is there some little canary in the coal mine there? Why are we leaving our friend out? Are they less friendly? And I guess then the bigger picture is the global oil markets have this big bet on, Asian demand still leading global demand higher, with an increasing shift to India being one of the key cogs in that wheel.
Mm-hmm.
So do we have any ability to influence India's, I guess, economic growth and then translated oil demand growth based on how we feel they're playing in this global world of all things oil, energy, AI? I don't know. It's an interesting one.
Yeah, definitely. I think the hardware manufacturing is going to play into that, where the U.S.-China relationship, hopefully diversifying away from kind of our reliance on the high-tech, high-value manufactured exports from China and diversifying that down to India. But yeah, it remains to be seen, because I think that there's kind of a lot of unknowns regarding the relationship between the U.S. and India. With that, I think we'll leave it, and definitely have some more things to talk about next week. So I'll catch you next Friday.
Sounds good.
Thanks for joining us at The Energy Desk. Again, this is a limited series, so if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.